Hi, it's Arjun. Ahead of what will be a week off to celebrate America's birthday on July 4th, wanted to just do a quick video here with sort of 5 thoughts on some mixture of key themes, research ideas on most on our mind as we're going to flip the calendar here to the second half of 2025. First topic, what is it going to take to get traditional energy, especially those exposed to the crude oil value chain, going again, especially if we are still in a super vol, not in a super cycle kind of environment. Second topic, private capital for traditional energy in particular. We talk about public companies having a private company mindset, but perhaps it's just more pragmatic to actually be a private company. And what are the opportunities? How do we think about that? The third is essentially a follow-up or was inspired by our Veriten's Close the Business Tuesday podcast with the CEO of Peabody Energy, Jim Grech. I thought it was a terrific interview, but is it time to rethink or at least take a fresh look the U.S. coal sector? Fourth, I want to talk about energy macro frameworks. A lot of people are in the all of the above camp. Some have been in sort of the energy transition, that very narrow framework that we have thought has been done away with. I actually think some of the above by region is probably going to be the way we're going to start thinking about things going forward. And then lastly, and not least of all, a change in Middle East. A lot has happened over the last 2 weeks, and the Middle East is not what it once was in terms of at least its impact on all markets. And I want to spend some time on commerce over chaos and what this means for the Middle East and energy markets going forward. So let me start with the first topic of what is it going to take to get traditional energy going again? So this is a picture we've shown before of the energy sector's market cap weight in the S&P 500, which is the gray line, and its earnings weight in the S&P 500. And I think first thing to remind people of, when we think about traditional energy's energy weighting, it is dominated by companies exposed to the oil value chain. If you're exposed to natural gas, if you're exposed to infrastructure and these kind of things, those are important themes that have been doing very well. It doesn't quite get reflected in this energy weighting. And that's a different topic that we've broached in the past. We should think about energy more inclusively, including power in these other sectors. But at least for the oil names, the earnings weight today is about 6%, and the market cap weight is 3%. What is it going to take to close that gap? Over time, we've noted, this is a line from my former colleague David Costin at Goldman Sachs, energy tends to punch its weight in the S&P 500. But just note that since the Russia-Ukraine peak, it's been 2 years of negative earnings revision. So I think the first thing is that specific downward negative earnings revision trend is going to have to turn around. But as you know, we've also been in the camp that it is a super vol, not super cycle kind of framework. And so I think it begs the question of how well can the sector do if we think oil is otherwise going to be range bound? And I think there's a couple things that we think about when we think about corporate strategy and how to be a leading company across the S&P 500. What is going to attract generalist investors? It is superior returns, superior per share growth. M&A are going to be the 3 main avenues. If you decide to sell yourself, that's one avenue. It's usually for smaller companies. For the larger companies, it's going to be a mixture of superior returns on capital and per share growth. And let me pull up one more graph on this. And so this is a picture, we've shown this a couple times in the past in Super-Spiked, which is a history of, this is cash on cash returns going back over the last 35 years now. And we have 3 lines here. We have the best in class companies, the first and second quartile, the sector overall, that's the green line, the sector overall, which is the gray line, and then the worst in class, the third and fourth quartile companies, which is the red line. From a sector standpoint, this is the cost of capital sector. I think for best in class companies, we would note that historically, they've been able to generate teens and even mid-teens type of returns. And I would note that for the last 4 years, the cash on cash return for first quartile companies are not dissimilar from what we saw in the super cycle era, the super spike period, as we called it, from the 2000s. Yet the S&P weight is really languishing. So a couple of things. I think people say, well, some of that's driven by Russia, Ukraine, so we're not going to count that period. The most recent trend, which we noted on the previous graph, has been more negative, and so there's been negative trends. I think if the sector wants to get back in good graces, if it wants to attract capital, it is going to be this mid to upper teens type cash on cash returns that I think the leading companies at least are going to have to aspire to. And we're going to differentiate a focus on those best-in-class companies from, frankly, everybody else. Who is going to be in this bucket of best-in-class? And I think those types of companies, if they can demonstrate mid to upper teens cash-on-cash returns, and we are raising the bar here a little bit, especially for best-in-class, or we're highlighting the need to be best-in-class, it's going to be one of the prerequisites. When you have those best-in-class returns, it then can translate it into better dividend growth per share, if that's the focus, and that is often the focus for the largest companies, or superior per share growth via stock buybacks and other things, especially at a time of a discounted valuation. The other opportunities we see, of course, for best-in-class companies at the smaller sizes, how do you think in a world of shale maturing, of possibly selling yourself? And we've already had a lot of consolidation. I don't know how much more there is to go, especially in the shale space. And I think in the absence of either selling yourself or being able to show that you can sustain these kind of best-in-class returns over decadal type timeframes, I think there's going to be a question of how do you add value? We've shown this a few times now. I don't want to beat it over people's head too much or create the impression that I'm all and only about stock buyback. But this is the Murphy USA example. I'll be brief since I've gone through it a few times now. If you can generate upper teens cash-on-cash returns, your reinvestment rate of 50%, if you can have a business where you're able to maintain volumes or grow them slightly, perhaps through bolt-ons, with that type of reinvestment rate, you can buy back a ton of stock, especially at a time the sector is seemingly very inexpensive. Murphy's reduced their share count. Murphy USA, I want to be very clear, it's the gasoline retailer, by 50%. And I don't think this business model or opportunity is for everybody. There will be some companies at the smaller end of the spectrum who decide they should sell themselves. It's not clear what the appetite is going to be by investors for companies who decide we need to go international or go to new areas outside of shale. And I do think for at least a select few, and it's a few, this is not a be-all end-all answer. For a select few, I think this is going to be one of the business model opportunities to look at. And how as companies, how as management teams and boards do you think about being your own best activist? We don't necessarily need external activism. It is up to management teams, it's up to boards to challenge themselves. How do I get into that best-in-class group? How do I think about the ability to generate mid to upper teens cash-on-cash returns? I'm going to say at reasonable oil prices. How can I have a reinvestment rate that's 50, maybe 60% to maintain volumes? And then how do I think about using that excess cash, at least in this example, for some, it could be through aggressive stock buyback type programs. I think this is now a good transition into the second topic, which is sort of private company type mindsets. And we're in a world where there is no doubt there is a lot of need for lots of different types of energy. But that public company business model at times can be somewhat restrictive in terms of what investors are allowing today. So at a time that the sector is generally out of favor, it's 3% of the S&P 500, and investors are therefore going to be instinctively very cautious about what they want companies to do. And even I myself said, hey, one of the avenues out there is follow the Murphy USA model. Now, again, not for everybody, but if you have very good returns, if you have a long enough lived asset base or can do bolt-ons, how do you think about a stock buyback model? Even I am saying for some, that's going to make sense. But for others, what is the right way to think about reinvestment opportunities in what I might call currently not in favor type place? It might be international. It might be non-Permian Basin domestic opportunities. It could be in Canada. It could be any of a number of places. And that is where the private company model is interesting. And, is at the height of sort of the energy transition era, the net zero madness, that you saw a lot of the large private equity companies get out of traditional oil and gas. I would hope and will be optimistic that they'll come back. A few have stayed in. Many might still be, at best dabbling in the space, but it's nowhere near where it was 10 plus years ago. But there's also the family office market. And while that is sort of inherently, presumably a smaller pool of capital than certainly the public markets or traditional large cap private equity, there are some interesting opportunities out there. And so if the public companies aren't going to be able to pursue these because the sector's out of favor and investors are sort of very narrowly focused on what they want to do, how do we think about private capital type opportunities? And we sometimes default too much to private equity. It can be private debt. It could be other, anything in between those equity and debt as well. I think it's an area that is going to present a lot of opportunity, especially at a time that a lot of traditional energy is currently out of favor. So this leads us to the third topic we want to address, which is domestic coal. And I would encourage everyone to look at the Veriten's Close the Business Tuesday podcast with Jim Grech of Peabody. Let me pull up a chart here. So I've shown this picture before. It is a picture of global coal production. Of course, I think I wrote about this. It was early 2023 or around that time frame. We had a series of sort of coal notes that was very much focused on what can we learn from peak coal to inform us about peak oil demand, which was the topic of the day a couple of years ago. And of course, what we found is that not only is coal not peaked, but it has continued and only continued to grow. So we've got very simply declines in coal production and demand in the OECD, US, Europe, Japan, but dramatic growth, especially in China. But we're also seeing growth in India and other parts of Southeast Asia. And so, I think a couple observations here. And first is, well, I've always thought this was the worst assumption in everyone's net zero model. I think oil demand is going to grow, but I accept there's some debate, at least especially over this decade. I think it's pretty clear natural gas is going to grow, but for sure, perhaps there was some debate at some point in time. There's no debate about coal. I mean, it is a large, abundant resource in a lot of these developing countries. And the idea that they're just going to ignore it is frankly preposterous, and you can't see it in any of the factual data. It is unquestionably growing. So we spent a lot of time on that. And we said, hey, coal hasn't peaked, so why do you think oil demand is going to peak? We made all those kind of arguments. But we have accepted, and we have done actually no real work, and we've just accepted as the received wisdom that the US coal industry should decline, and if it goes away, it goes away. That had been our operating model. I don't think we had a willful view of that. We just observed, yes, it's in decline, and it's probably going to continue to decline, and didn't spend a whole lot more time thinking about it. Yet here we are today, where we've had a lot of coal plant retirements. We know our grid is stressed sort of across the country. We know power demand is rising. We know we've added a lot of intermittent resources. And does coal deserve a rethink? And so before people overreact to these messages, and given that my audience is either mostly traditional oil and gas, as some element of renewables and new energies and clean folks who also do listen to it, which I appreciate, there's almost no appetite, I think, amongst the vast majority of Super-Spikes subscribers to talk about coal. But I'm going to talk about it because one of our mottos is we need to have a healthy and honest energy conversation. And I'm going to ask, is there a role for coal here? So let's just look at some numbers here. First, US coal production from its peak in 99 or 2000, whatever year this is, has kind of about fallen in half. And so in exajoules, it's gone from, what is this, about 22, 23 exajoules down to about half that level today. And just look at the growth in China. I mean, it is swamped, absolutely swamped our declines. China has gone over the same period from about 30, trying to look at the graph, to about, it's tripled, 30 to 90 exajoules of coal production. And India is just starting to get going, and Indonesia and the rest of Southeast Asia. So the question would be a couple things. We've retired a bunch of coal plants. Is it feasible to bring them back on? It seems very unlikely we're going to have a new coal power plant wave in this country. We can debate whether we should. But what is the environmental footprint of the new, presumably more modern and cleaner coal plants in places like China? And how does that environmental footprint compare to other alternatives? If what we care about is reshoring some of our manufacturing base and our industrial base, is there a role for coal there? And so we've not done the numbers yet, and I should just do it, but I'm going to make the point. There's a graph that people use that shows there are no economically rich countries that are somehow energy poor. It's like a perfect correlation. If you're using more energy, you're economically richer. If you're using less energy, you're economically poorer. Perfect correlation. Everyone, I think, agrees with that wherever you are on the energy debate. What about industrial manufacturing and coal? Is it a coincidence that China has become the factory of the world? It dominates all these different industries in manufacturing, and it has come through dramatic increases in coal. And that historically, from the Industrial Revolution, that drove a lot of our industry. Now, I don't want to overstate the point because I just need to run the numbers, quite frankly. But if we do care about bringing manufacturing back, Do we need to think about coal differently? And I think it's worth doing the work. Now, let's be clear. There are not that many publicly traded coal companies. This isn't necessarily common for the public equity investors out there. I'm not advising oil and gas companies to get into coal. There's no message about that. This probably fits the previous bullet or the previous point I made about private capital opportunities. And it's just hard to believe that look at how much coal is going in the rest of the world. Why are we just giving up on it here? Um, since coal production and coal power plants are growing dramatically in the world, at the barest of minimums, might there not be more export opportunities? If LNG exports and natural gas exports is something we all agree is or most of us agree is a good thing for our country, and it helps feed the energy needs of the rest of the world, why wouldn't we look to export our coal to the extent there are places where that is going to make sense? So I don't want to overstate this other than to say I think it's worthy of study. And while I have said international coal is growing non-OECD, is it not worth at least examining what are the opportunities domestically? So I think this coal discussion feeds into the fourth point. And I'm going to have to give credit to a colleague at CGIP who kind of put this, I think, slightly in a joking way, but I think it was a good comment anyway, which is we went from the energy transition, this sort of only renewables out of fossil fuels, to now all of the above, supposedly. Yet it sure seems like no one's actually for all of the above. Everyone's for their favorite some of the above type options. I thought it was a very funny and actually insightful comment. I don't think there's anyone for all of the above. It tends to be that if you're renewables oriented, that's kind of what you're for. Maybe now you accept nuclear. Most oil and gas people will say we're for oil and gas and nuclear. I know very few oil and gas people that would advocate for coal, and they might grudgingly accept from renewables. So everyone's got their favorite kind of some of the aboves they like. I think somewhat ironically, it's probably the coal people who are most all of the above in nature. Though I do think they might make fun of solar and batteries a little bit. But anyway, one of the things we push back on in the old net zero energy transition narrative was this sort of one size fits all approach where it can't possibly make sense for countries like Germany to be emphasizing solar and wind, but it does make sense for sure for India and other developing nations, especially that are closer to the equator where the sun is shining strongly, to absolutely be thinking about solar and batteries as one of their alternatives, especially since a lot of those countries don't have oil and many of them don't also have natural gas. And so as we look at building out what is our outlook for energy demand, what are the opportunities, it most likely should be some of the above, country specific. So I'll take Canada example. I've really pushed back on the hard on the energy transition narrative that somehow Canada's emissions are a problem when most of it's coming from producing their oil and gas, as opposed to the how many people could possibly live in Canada? 40 million people, 45 million people? Can't be that many. The emissions from those people can't be anything more than the biggest rounding error on earth. And so I always thought this sort of top down, oh, Canada is not decreasing their emissions was a ridiculous viewpoint towards that country specifically. So my point is, what are the sum above opportunities that make sense by region? In Canada, it is producing their oil sands, it's producing their natural gas, and they have a whole bunch of critical minerals and other metals that the world needs. They absolutely should be producing that because they need it. In the US, we have a lot of oil, natural gas, and coal. We're currently not anywhere good when it comes to the value chain of various new energy opportunities. Now, can that change? It ironically might take coal to change that. Why don't we think about that for a few seconds? But I think we as a country, the United States, should be focusing on our traditional energy opportunities from a supply side standpoint. For places like India, I think solar and batteries with coal are going to be how they think about things with a mix of nuclear and maybe some LNG, but as sort of the fourth fuel they're using, if you will. I'm not sure you want to think about LNG as baseload to a country like India. And it's really, as you build up macro frameworks, it's going to be some of the above, and it's going to be different some of the aboves depending on where you are. And I think when we think about how we model out demand, whether it's by country or region or what have you, I don't think those old NEDs, I've said it so many times now, energy transition narrative type frameworks worked, but a blanket all of the above isn't quite accurate either. it is going to be some of the above by region. The final topic we want to talk about is a changing Middle East. And I have to say, we've said it and we wrote a lot about how geopolitics is sort of overanalyzed when it comes to the long-term outlook for oil specifically. And we observed a bearish, a bullish, and a neutral prior turmoil period. But I got to tell you, it is still stunning to see that you had Israel and Iran in active warfare, and then the US dropping 14 bombs, I guess, on various nuclear sites as well. And crude oil couldn't even get back to its January 2025 highs. So yes, we probably had at the peak built in a $20 risk premium from where we were pre any of the turmoil having actually started. But it was pretty short-lived and pretty subdued. And we don't need to recreate all the reasons for that in terms of excess OPEC spare capacity, the shale revolution, subdued demand environment at the moment, and all that kind of stuff. I think there are some bigger lessons and takeaways here, which is the Middle East is not, and we've said this before, but let's emphasize it. It's not the Middle East of 20 years ago, or certainly the 1970s. And even though I think only now some of us actually lived through the 70s, I was in elementary school, and many people weren't even born then, that Arab oil embargo, the Middle East is turmoil. The turmoil is always bad for the Western world because oil prices spike. That mindset still persists. And it is not proving true. And there's no better evidence of that than Israel and Iran being in active war. And we saw a pretty subdued reaction to the what I think is being called the 12-day war. I want to highlight three countries that I think have changed a lot and where they are going to define the Middle East going forward. It is Saudi Arabia and it is United Arab Emirates. Both are very large oil producers. They're large energy producers. I've said regularly, Aramco is a very impressive company. I have found Amin Nasser, the CEO, to be, frankly, one of the most impressive CEOs that I've come across. I've had the good fortune to meet him a couple times. I can't say I know him as well as a lot of the US or Western European CEOs, but a very impressive company management team. Same thing with ADNOC, Abu Dhabi National Oil Company. I've had, again, the good fortune to meet a whole number of different people in that organization over the course of my career, including recently. And these really are two bellwether major energy companies, major oil and gas companies. And I think when we look at what is going on in Saudi Arabia, when we look at what's going on in Dubai and Abu Dhabi and the Emirates in general, I think the line it comes from President Trump, so I'll apologize to probably half of you for invoking his name, the commerce over chaos, and how important of a theme is that. And without going over my skis, I'm an energy analyst, not a geopolitical expert. Let's just think about what the reaction was within the region to Israel and Iran being in conflict, in direct active conflict. And so as we think about the Middle East going forward, I think the energy that comes from Saudi Arabia, the energy that comes from UAE, when I think about how those companies, Aramco and ADNOC, are pursuing their own strategies going forward, I think it's a real role model, frankly, to the United States, to Europe, and to the rest of the world. They're probably as close to all of the above as anybody, but they don't have everything, so they're doing their version of some of the above. And I think historically, Israel as a country, they're clearly not a major energy producer. They do have a natural gas field or two. But they seem to be really important to the same theme as well of a changing Middle East. And again, I'm gonna stick to energy and not speculate on how Israel and Saudi and UAE are going to get along or not get along going forward. But I think as oil experts, that old model of the 1970s style, quote, Arab oil embargoes, it's bad for the world, that is it killed now? Can we say it's killed? I'm not saying there's never going to be a war or turmoil in the Middle East. By the way, we have turmoil in Europe right now. We have turmoil in many different places. It's changing. I think that change is worth studying. I think it's worth understanding. And there's some good things going on in these countries that I think, frankly, the rest of the world could learn from. So I'll end this video on a personal note. Let me wish America a happy birthday. I'm going to enjoy a week off, going to finally get some golf in. We're getting some better weather here in the US Northeast. My son is graduating from college, so congratulations to him. We'll have two out, one to go. And I hope everyone has a chance to enjoy summer, which is kicked off here in the US. Thank you.